Welcome back to the Deep Dive, where we take a stack of sources, articles, research papers, clinical data, and distill them into the only conversation you need to be thoroughly well-informed.
Today, we are diving deep into a fascinating anomaly in the diagnostic sector, starting with the conclusion that it just seems to defy basic financial logic.
It is, quite literally, a value inversion, which is incredibly rare to find, especially in a growth-focused medical company.
We're talking about Biodesix, ticker BDSX, a high-growth diagnostic firm. Now, here's the number that really sets the stage for our entire conversation.
Okay, let's hear it.
The market currently values the entire enterprise at approximately $64 million.
$64 million, that's the price tag. Now, based on the rigorous financial modeling found in our sources, the same company is expected to generate $88.5 million in high-margin revenue.
For fiscal year 2025.
You heard that correctly. The market cap is less than its projected annual sales.
This is why the alarm bells went off for us. I mean, when a high-growth biotech or diagnostic firm is trading at a price-to-sales ratio of roughly 0.7, well, there were really only two rational explanations.
Okay, what are they?
One, the market sees an immediate fatal flaw, something like guaranteed insolvency or a patent expiration that wipes out the core business tomorrow.
The doomsday scenario.
Exactly. Or two, we're looking at a classic dislocation, a massive gap between price and intrinsic value caused by, short-term volatility and fear.
And that, listeners, is our deep dive mission today. The sources present a compelling argument that this company has not only avoided a fatal flaw, but has achieved a critical operational turnaround.
A huge one, reaching positive adjusted EBITDA in the fourth quarter of 2025.
And they've done that while establishing a dominant, specialized, and highly defensible position in lung cancer diagnostics. So is this a deservedly discarded asset, a cigar butt destined to burn out, or is it a powerful future compounder that's just temporarily disguised by market panic?
We're stripping away the stock price noise, all the emotional trading, and focusing entirely on the underlying business physics. We're going to use a fixed, structured analysis.
So we'll be examining the clinical problem, the financial architecture, the barriers to entry, and, crucially,
the signal sent by the management and the insiders, the people who know the company best. For you, the learner, the core insight here will be determining whether this turnaround story is built on sound clinical and financial footing.
Okay, let's unpack this with the precision it deserves. Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding.
You understand the colossal disconnect between price and value here. We absolutely have to start by understanding the specific clinical problem Biodesix solves.
And our sources refer to this as the agony of the indeterminate nodule.
Right, and let's ground this in the real world. Imagine you're a pulmonologist and your patient comes in. Let's call her Sarah, a 65-year-old with a history of smoking. Her routine CT scan, maybe for a totally unrelated symptom, has flagged a small, round growth of tissue on her lung, a pulmonary nodule.
And this is the moment of agony.
Exactly. You have no idea if that spot is aggressive, early-stage cancer that requires immediate surgical removal, or if it's just a harmless, benign scar tissue, maybe a fungal infection that simply needs safe, periodic monitoring.
The clinical dilemma is profound, and the conventional tools available to the physician are, well, they're terrible.
They're awful. To gain certainty, the gold standard is an invasive biopsy. This procedure costs the healthcare system upwards of $15,000.
$15,000. And critically, it's physically risky for the patient. The risk is enormous.
We're talking about potential complications like a collapsed lung, a pneumothorax that happens when the needle actually punctures the lung lining.
And beyond the physical risk, there's the psychological toll. The patient is thrust into the state of massive anxiety, essentially being told, we need to stab you through the rib cage to see if you have cancer.
It's brutal. And this creates what the sources accurately define as the zone of uncertainty.
Right. So doctors facing legal and ethical pressures often err on the side of caution, and this results in two pretty catastrophic possibilities.
The first is they perform unnecessary, costly, and painful invasive procedures on nodules that, in the end, turn out to be benign.
Wasted resources, patient harm.
And the second is even worse. They delay diagnosis on aggressive cancers by electing for the seemingly safer watch-and-wait approach.
Losing weeks or months of critical time as the tumor grows.
Exactly. Billions of dollars are wasted globally in this uncertain diagnostic zone, and tragically, the delay in treatment costs lives.
So Biodesix isn't selling a drug. They're selling the intelligence layer, the critical diagnostic data that sits right in the middle of this high-stakes dilemma.
That's it. Their core business model is built around what the sources call the notified toll bridge model.
A toll bridge. I like that framing.
It's precise. It's a toll bridge because every single patient in this zone of uncertainty has to pass through this critical decision point, and Biodesix aims to monetize that moment.
With a simple, non-invasive blood test. Safer, cheaper, and faster than any invasive procedure.
And they offer a sophisticated dual-pronged strategy to address the entire spectrum of uncertainty.
Okay, so let's break down how this dual strategy works. You have the patient, Sarah, with her indeterminate nodule. What's the first step in the Biodesix system?
The first test is often the Notify CDT. That's their rule-in test. Its sole function is to identify high-risk nodules, the ones that are likely malignant and need immediate attention.
And the science here is key, right? This is where their moat starts. They're using proteomics, detecting specific autoantibodies.
Autoantibodies, that's the immune system fighting back, right?
Exactly. When a microscopic tumor starts to develop, even before it sheds detectable DNA fragments, the body's innate immune system recognizes the tumor antigens as foreign.
So it hits the alarm system.
Precisely. It starts producing specific autoantibodies to fight it. Notify CDT measures the concentration of 7 of these specific autoantibodies.
So if that test comes back high, it's essentially the body telling the doctor, warning, an immune war is happening here.
That's a perfect way to put it. A high result rules in a high probability of cancer risk. This gives the physician the immediate objective confidence and a clinical justification they need to bypass surveillance and proceed immediately to aggressive intervention.
So a targeted biopsy or even direct surgical resection, it eliminates those dangerous delays.
Right. And then if the CDT test is negative or maybe inconclusive, the sample moves to the second complementary test.
The Notify XL2, the rule-out test.
Okay, so this one handles the other side of the dilemma.
The XL2 is designed to address the other end of the problem, identifying the 70 to 80% of nodules that are actually benign.
And how does this one work?
This test uses a sophisticated proteomic classifier, measuring the ratio of 2 specific blood proteins, LG3BP and C163A. But the real genius here is that they integrate this hard biological data with 5 crucial clinical risk factors, things like Sarah's age, her smoking history, the nodule's size and location in the lung, and its visual characteristics on the CT scan.
So that integration of patient history with the biological markers is what elevates it beyond just a simple lab test.
It's everything. And the output of that complex calculation is an incredibly compelling metric that resonates instantly with doctors and payers.
And what's that metric?
A negative predictive value, or NPV, of 98% when the test returns a likely benign result.
98%, that's the golden number.
It is.
Wait, let me stop you there and just reflect on what that means for a practicing doctor. If the test says it's benign, you're telling me there's only a 2% chance they're wrong.
That's right.
That's a massive shift in liability and certainty. It allows them to safely tell the patient, Sarah, we can safely put you on a 6-month CT surveillance schedule. You do not need to risk that $15,000 invasive procedure today.
That is the core value proposition. It prevents unnecessary surgery, it reduces hospital liability, and it saves the healthcare system huge amounts of money.
So that durable dual-pronged approach captures the entire spectrum of the indeterminate patient population. It makes the business a stable toll bridge, regardless of the final diagnosis.
Exactly. But that's not the whole story. While the lung diagnostics are the steady, compounding engine, the cash cow, the sources point to a second, far more explosive revenue stream.
The one that acts as a hidden call option.
Development services. This is the B2B side, where Biodesix partners with major biopharma companies, AstraZeneca, Genentech, the heavy hitters.
And what are they doing for them?
They're helping them discover companion diagnostics and new biomarkers. They're essentially selling their scientific engine as a service.
And why is this countercyclical and so high value?
Because pharma R&D budgets are huge and relatively stable, and they fund these expensive service contracts. Biodesix uses its proprietary artificial intelligence platform, the Diagnostic Cortex.
Which is trained on hundreds of thousands of samples.
Right. They use that to find the specific biomarkers a new drug needs to identify the right patients for a clinical trial. They're essentially accelerating drug development for big pharma.
So they're not just finding cancer anymore, they're finding the key that unlocks a multi-billion-dollar drug.
That's the potential, yes. And this segment demonstrated a staggering 97% year-over-year growth in Q3 2025.
Wow.
Now, development services is still small, around $1.9 million in Q3, but its future value is immense. If one of these companion diagnostics becomes linked to a blockbuster drug launch, it triggers long-term, high-margin royalty streams.
And that potential alone could arguably justify the entire current $64 million market valuation.
It could. It's
Right.
a very real, very lucrative hidden call option that the market right now seems to be completely ignoring.
Chapter 2, Management Evaluation.
Okay, so when you're looking at an investment that's trading at distress levels, you are absolutely betting on the people running the show.
In the chaotic small cap world, management's integrity and execution discipline are, they're perhaps the most important factors. Let's look at management execution. Integrity of guidance.
Right. Under CEO Scott Hutton's leadership, the team has established a rare pattern in the diagnostics world. We can call it promises kept.
That's a good way to put it.
Historically, early-stage diagnostic startups are notorious for overpromising on revenue, on timelines.
All the time.
Biodesix did the opposite in 2025, which gives you strong faith in their forecasting methodology. They successfully beat the top end of their 2025 revenue guidance.
They guided for 84 to 86 million.
And they're now delivering an estimated 88.5 million. That suggests competence, conservative internal modeling, and just excellent sales execution.
But the single most critical deliverable, the foundation of this entire turnaround thesis, was the affirmation of positive adjusted EBITDA expectation for Q4 2025.
Yes. Management promised a transition, and the sources suggest they delivered it. This is the moment the narrative shifts from a cash-burning startup to a self-sustaining entity.
And their operational agility is also evident in their sales strategy. They didn't just stick rigidly to the plan of targeting specialized pulmonologists, which is, a limited channel.
No, they executed a highly intelligent and successful strategic pivot. They refocused significant sales efforts toward the primary care channel.
Why there?
Because primary care physicians often order the initial CT scans. They are the first to encounter the indeterminate nodule. So if you can get the blood test used early by the primary care physician, you capture the patient at the top of the funnel.
And the results of that pivot were immediate and strong.
Unbelievably strong. The sources show orders from the primary care channel increased by a staggering 75% in the period.
Wow, 75%.
That proves this management team isn't just capable of running the existing business. They're agile and effective in unlocking massive, new, and necessary distribution channels.
Okay, let's discuss capital allocation. Discipline over ego. In high-growth sectors, we often see companies raise money only to destroy shareholder value through expensive, over-leveraged, and just ill-advised M&A.
Right. And what was Biodesix's capital philosophy?
It was pure discipline. They avoided the temptation of splashy acquisitions entirely. Their focus was almost exclusively on high ROI organic growth.
So the major investment wasn't buying another company. It was expanding the sales force, aiming for 93 to 97 representatives by the end of 2025.
That is the ultimate vote of confidence in the core product, isn't it? They're spending money not on shiny new toys, but on feet on the street.
Believing that the cost of hiring a sales rep is far outweighed by the annuity stream of recurring high-margin test orders that rep will secure over the next few years.
It is the definition of intelligent reinvestment into operating leverage.
And furthermore, their actions in the capital markets showed prudence under pressure. They executed an at-the-market, or ATM, offering in Q3 2025, raising $4.8 million.
Now, a skeptic might say, raising equity when the stock is this cheap is terrible dilution. So what's the management counterargument?
The counterargument is that it was smart risk mitigation. They raised equity when they could, not when they were desperate and had to.
Okay.
It preemptively shored up the balance sheet with working capital, de-risking the entire path to sustainability just ahead of the critical profitability crossover.
So it gave them a cushion against unexpected delays in collecting accounts receivable.
Exactly. It was an act of financial prudence, minimizing the immediate liquidity risk before they achieved self-sustaining operations.
So we have a leadership team that sets conservative expectations, beats them, executes a critical strategic pivot successfully, and allocates capital rationally toward organic growth. That provides a pretty solid foundation for the investment thesis.
A very solid foundation.
Chapter 3, Financial Health.
Okay, let's now move into the core engine of the business and look at the financial machinery that proves the turnaround is real, starting with revenue velocity and acceleration.
We stated the full year number, $88.5 million estimated revenue for 2025. That's a strong 24% year-over-year growth.
But for a turnaround story, the rate of growth matters more than the size of the growth. You need to see acceleration.
And the acceleration data is compelling proof that the sales strategy is working.
It is. The fourth quarter of 2025 alone saw estimated revenue of $28.8 million.
And that represents a significant 41% increase year-over-year for the quarter.
You want to see that velocity increasing as the company scales its sales force and penetrates new markets like primary care. This rapid acceleration validates the market adoption curve and the efficacy of the sales reps they hired earlier in the year.
And we noted the quality of the revenue composition in Q3 2025. The steady foundation, lung diagnostics, grew a respectable 16% year-over-year to $19.8 million.
That indicates market share gains. But the explosive engine development services growing 97% year-over-year to $1.9 million. That confirms the diversification strategy is bearing fruit.
And this high-octane B2B revenue is crucial because it's generally less volatile than direct patient reimbursement, and it carries those extremely high service margins,
Which increases the overall quality of the revenue base. And that brings us to the most spectacular financial metric in the entire analysis.
the superior gross margins.
This number is a definitive sign of a powerful, unique, and durable moat. Biodesix reported a gross margin of a stunning 81% in Q3 2025.
81%. And that was an improvement of 400 basis points over the prior year.
Right. If you're selling a commodity, your margins are razor thin. If you're selling an 81% margin product, you're selling unique, clinically validated decision-making intelligence that no one else can easily replicate.
So what does that 81% actually unlock for the company's future? We hear the term operating leverage thrown around, but let's define what that means here in concrete terms.
Operating leverage is the key to the entire thesis. Their core infrastructure, the lab, the specialized staff, the proprietary diagnostic Cortex AI represents massive fixed costs.
Right.
The incremental cost of running one more blood test is relatively minimal. This means that once they pass the break-even point, 81 cents of every additional dollar of revenue flows directly to the bottom line to cover fixed expenses and become operating profit.
And this mechanism, this financial physics, is why the path to sustainable profitability, the inflection point, is so steep and fast.
Precisely. And speaking of the inflection point, we do have to acknowledge the history. All growth diagnostics companies endure years of losses as they build out the infrastructure and conduct clinical trials.
But now we've reached the transition point.
Yes, the magic words have been spoken. The affirmation of positive adjusted EBITDA in Q4 2025.
And this fundamentally changes the company's risk profile.
Completely. It proves the core operation, the diagnostic testing business, can generate more money than it consumes. It means the business is self-sustaining and theoretically reduces reliance on constantly needing to raise capital just to survive.
But we have to be transparent about the accounting, though. The net loss was still $8.7 million in Q3.
That's vital context. The difference lies in non-cash charges. Net loss includes large mandated accounting items like depreciation of their expensive lab equipment and stock-based compensation.
Okay.
Adjusted EBITDA strips these out to focus on the operational efficiency. How much cash is the core testing business generating? Turning adjusted EBITDA positive proves the core engine works.
And that sets the stage for the net loss to disappear as revenue continues to grow and that leverage kicks in.
Correct. Which brings us squarely to the main caution point and where we need to introduce some skepticism.
Balance sheet scrutiny and liquidity risk. This debt is the reason the stock is priced so cheaply, isn't it?
Absolutely. This is the acute risk factor the market is pricing in. As of late 2025, the company had a tight cash position of $19 million.
And against that, they carry approximately $72.9 million in total debt.
That ratio screams distress. A short seller will point to that number instantly and say, insolvency is imminent.
So, if that debt is the market's main fear, why isn't this a fatal flaw? What are the mitigating factors that prevent immediate bankruptcy?
We have three major mitigating points. First, the trend. The cash burn rate is plummeting because of the positive EBITDA crossover. The operational bleeding has stopped.
Okay, that's number one.
Second, the Q3 cash position was artificially lowered by high accounts receivable. They made the sales, and now they're simply waiting to collect the large checks from Medicare and private insurance payers.
So it's not a failure to sell, it's a timing issue.
Exactly. And the third factor is their demonstrated access to capital, even if it was dilutive. The ATM offering, while painful, proves that management has the ability to raise capital and manage short-term liquidity when needed.
Which provides a bridge until sustained positive operational cash flow arrives in early 2026.
Correct. The entire investment hinges on that EBITDA crossover, quickly translating into genuine operational cash flow to service and eventually pay down that debt.
Finally, we need to address the optics that often panic retail investors. The reverse stock split, the 1-for-20 they executed in September 2025. On the surface, it looks like a desperate act.
It was a necessity. It was forced by the need to maintain NASDAQ listing compliance, which requires the stock price to stay above $1.
But the silver lining is immense and strategic.
It created institutional investability. Many large funds, often mandated by their charter, cannot purchase stocks trading below $5.
So by consolidating the shares and getting the price back up into the high single digits, they're making the stock accessible to this vast pool of institutional capital pension funds, mutual funds that couldn't touch them before.
Exactly. And furthermore, it resulted in a very small share count, only about 8 million shares outstanding.
A tiny low float.
Which means that if the company delivers genuinely positive news, a significant contract, or strong profit reports, that limited supply of tradable shares can lead to dramatically outsized and rapid price appreciation. The split, though optically negative, was a key step toward attracting sophisticated capital.
That wraps up part 1. We've established a highly specialized business, a management team executing critical promises, and financials showing massive leveraged acceleration toward profitability.
Before we jump into part 2, where we will discuss the powerful moats that protect this business and the high-conviction insider buying, we need to take a quick break.
If you are finding this level of detailed, structured analysis helpful, please take a moment to hit that like and subscribe button. It ensures more people can find discussions like this.
Like and subscribe to Stock Analytics AI.
Apologies to all members. We have been demonetized by YouTube for repetitive content. They clearly don't understand what we're doing here. The good news is that we are going to continue. For members, sign up at stockanalytics.ai, and within the next few weeks, we will upload access to the full 600 videos for the S&P 500 and NASDAQ 100, and the coming 100 top AI stocks of 2025, $5 per month, and we will begin adding more features to the web application by the week, so joining early will be a great advantage. And we are back, ready to dissect the competitive landscape and the ultimate sign of conviction.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment.
We established that this is a growing, potentially profitable business, but the core question remains, is the business defensible?
Right. Or could a deep-pocketed competitor copy their test and crush them? Let's analyze the fortified moat, barriers to entry.
In high-stakes diagnostics, moats are built out of regulation, clinical data, and proprietary science. And the most impenetrable advantage Biodesix possesses,
The one that guarantees their stellar 81% gross margins.
is the regulatory and reimbursement moat, specifically the Advanced Diagnostic Laboratory Test, or ADLT, status granted by the Centers for Medicare and Medicaid Services, CMS, for their Notify CDT test.
Why does ADLT status translate directly into an economic fortress?
ADLT status is extremely difficult to obtain. It's reserved for tests that are unique, innovative, and provide clinical utility that no existing test offers.
Okay.
Crucially, obtaining this status gives Biodesix a specific protected reimbursement rate, set at $649 by CMS.
And that fixed protected price is the entire ballgame, isn't it?
It's everything.
If they didn't have ADLT, a competitor could come in tomorrow, charge $300 for a similar test, and force a destructive price war that would just vaporize those 81% margins.
Exactly. This status prevents the commoditization that plagues so many other lab tests. For any competitor to truly challenge Biodesix, they would have to spend tens of millions of dollars.
And years of time.
And potentially 5 to 7 years running their own massive clinical trials, securing FDA approval, and then applying to CMS to prove that their test is significantly superior or different enough to warrant its own protected rate.
And Biodesix has 5 tests already covered by Medicare, stacking those regulatory barriers high.
Right. Beyond regulation, doctors need proof. That leads us to the clinical evidence moat. Changing medical practice is like turning an aircraft carrier. It takes mountains of verifiable data.
And Biodesix has spent over a decade and massive capital generating that data through large-scale, multi-center clinical studies like Oracle and Altitude.
These aren't just small in-house studies. They're hard-won, peer-reviewed clinical data sets that prove economic and clinical value.
And the economic data is particularly compelling for hospital administrators. We noted the Oracle study showed a 74% reduction in unnecessary invasive procedures on benign nodules.
That 74% is what makes the sale to insurance payers easy. It's not just about a better test, it's about eliminating massive sunk costs for the healthcare system. This body of clinical evidence is virtually impossible for a cash-strapped startup to replicate quickly.
Cementing their reputation as the leader in this specific niche.
Which brings us to the modern mode, the data mode. Tell us again about the Diagnostic Cortex AI platform.
The AI creates a classic data flywheel effect. They've analyzed well over 100,000 biological samples.
So every single test run, every new patient sample, feeds back into the algorithm, improving its sensitivity and specificity.
An AI trained on over 100,000 data points will always outperform a new competitor trying to start with, say, 10,000 samples.
The more Biodesix tests, the smarter and more robust their product becomes, raising the barrier of entry for any challenger.
Let's delve back into the core scientific distinction, the science mode, proteomics versus genomics. This explains why the product works so well in the early detection niche.
This is an essential distinction for the learner. Many highly capitalized liquid biopsy companies focus on genomics. They're looking for DNA mutations shed by the tumor.
And as we discussed, for small early-stage nodules, those tumors shed very little DNA.
Making genomic tests less sensitive at the critical moment of early diagnosis.
So if genomics is looking for the physical trace of the burglar, the cancer cell DNA, how is Biodesix's proteomics different?
Proteomics, which studies proteins and immune response, is listening for the burglar alarm.
The burglar alarm, I like that.
They're measuring the protein signature of the body's immune system reacting to the presence of the tumor. And the alarm system often triggers much earlier and provides a stronger, clearer signal than the faint physical traces of tumor DNA shed by a tiny nodule.
So this biological approach gives Notify CDT a powerful scientific sensitivity advantage, specifically tailored for these early indeterminate nodules.
Right, and this proprietary science dictates their success in competitive segmentation.
Which answers the question, why haven't giants like Guardant Health, worth billions, just created their own nodule test and crushed them?
Because the market is immense, and Biodesix is a dedicated specialist dominating the pulmonary nodule niche. Guardant Health focuses on therapy selection and recurrence monitoring for established cancers.
Different problems.
Different problems. Grail focuses on general pan-cancer screening, which is a massive endeavor, but lacks the specific clinical evidence required to resolve the immediate, agonizing dilemma of the indeterminate nodule.
So Biodesix's specific clinical evidence and ADLT status have locked them into this lucrative, defensible sliver of the market.
Exactly. And the contrast with their primary direct competitor, Veracyte's Recepta, is also crucial because it demonstrates the distribution advantage we talked about earlier.
Right, how so?
Veracyte's test is largely an adjunct used during a bronchoscopy procedure, testing cells collected invasively in surgery.
So you're already in the operating room.
You are. Biodesix's Notify is a simple, easy-to-use blood test used before any invasive procedure. This operational difference gives Biodesix the top-of-the-funnel advantage.
And crucially, it allows for mass distribution into the primary care channel,
which is inherently much larger and faster growing than specialist pulmonology centers.
Finally, we should note the powerful industry tailwinds pushing this company forward. They aren't struggling against the current, they're sailing with a demographic boom.
Two main forces. First, demographics. The baby boomer generation, the largest cohort in U.S. history, is aging into their 70s and 80s.
Which mathematically increases the incidence of pulmonary nodules, their core target market, year after year.
And second, screening initiatives. Expanded USPSTF guidelines for low-dose CT or LDCT screening are driving an explosion in the number of incidental findings.
More screenings mean more nodules found.
And every new screening program creates more patients facing the exact "what do we do with this spot?" question that Biodesix answers perfectly.
Chapter 5. Ownership Structure.
We've established the operational execution and the strength of the moat. Now we move to the most powerful signal of conviction available to external investors.
Who is buying the stock internally? Let's talk about the insider vote. Jack Schuler's high conviction purchases.
Jack Schuler is not just a director. He's a diagnostic industry legend. He was the president and COO of Abbott Laboratories. He's a renowned high-conviction value investor in the medical field.
So when someone with that deep institutional knowledge and track record puts their personal capital into a stock trading at distress valuations?
It warrants immediate, serious attention.
Let's detail that cluster buy signal because it wasn't just a token investment to satisfy compliance.
No, it was a massive statement of faith. Schuler purchased approximately $3.5 million worth of stock on September 3rd, 2025.
Right around the time of the perceived negative event, the reverse split.
Right, and this was followed by consistent, smaller purchases throughout November 2025, including subsequent buys of $100,000 and $200,000. This sustained buying spree, totaling millions, signals absolute conviction.
So what does Schuler know that the market does not? Why would he buy millions immediately after a reverse split, which often signals a troubled company?
He sits on the board. He has intimate knowledge of the company's crucial internal metrics. He knows the daily sales reports and the collection rates on accounts receivable.
And most critically,
He knows the status of the biopharma contracts that drive the explosive development services growth. His aggressive buying, timed precisely as the company was crossing the critical profitability threshold in Q4, is an unmistakable internal affirmation that the turnaround is real and durable.
so he's signaling that the stock is materially mispriced. He is betting on his own knowledge against the market's collective fear.
And crucially, this conviction wasn't isolated.
That's right.
We saw broader insider alignment.
Other key insiders, including Lawrence Kennedy and John Patience, also made significant personal purchases in November 2025.
And when multiple key decision-makers who know the clinical trial data, the biopharma contracts, and the sales trends are simultaneously putting their own cash into the stock.
It moves the signal past just an idiosyncratic belief and toward a consensus internal vote that the company is undervalued.
And this simultaneous buying is historically correlated with strong future stock outperformance.
Chapter 6. Risk Assessment.
No investment offering a potential multi-bagger return is without significant risks, especially one trading at a steep discount.
The discount exists because of perceived risks. We need to be rigorously clear about the threats to this thesis.
The primary, most acute, and most existential risk is the liquidity and debt risk, and we cannot overstate this.
The tight balance sheet, $19 million in cash versus $72.9 million in total debt. That's the reason the stock is currently trading at 0.7 times sales.
It is. The market is pricing in the high probability of a debt default or a highly dilutive capital raise.
A skeptical investor would argue that even with positive adjusted EBITDA, the debt service obligations might quickly exhaust that $19 million in cash.
The success of this bet hinges entirely on the profitability crossover, translating almost immediately into robust, positive operational cash flow.
Exactly. We have to monitor the Q1 2026 operational cash flow closely. If that operational cash flow remains negative longer than expected, maybe due to slow reimbursement collection or unexpected sales cycle volatility, the debt load could become overwhelming.
And that would force a major, highly unfavorable debt restructuring or an equity raise at depressed valuations.
Effectively wiping out the value proposition. This is the thesis's single point of failure.
Absolutely. Next, the Achilles heel for any company relying on government payment. Reimbursement policy risk. They have the protection of ADLT status, but healthcare policy is always unstable.
The ADLT status provides massive protection, but it's not immutable.
It's not. If CMS or major private payers, for instance, decide to radically overhaul their diagnostic test policies in the future, it could bypass the current ADLT protections.
So any future mandated cut to the reimbursement rate for diagnostic tests, even a small cut to that $649 rate, would directly and severely impact those spectacular 81% gross margins.
Because of the massive operating leverage involved, yes.
And finally, the execution risk of sales expansion. The entire growth engine is predicated on the success of those 97 new sales reps.
This is a classic growth risk, scaling. Management has made a huge investment in expanding the sales force if they overestimated the productivity of those new representatives.
If the market adoption in primary care is slower than anticipated, or if the training pipeline is inefficient,
the added fixed costs will fail to generate sufficient revenue volume. This scenario would cause a reverse in the operating leverage, resulting in margin compression and pushing the critical EBITDA crossover back into negative territory.
So you're betting heavily on management's ability to execute this scale-up efficiently.
Very heavily.
Chapter 7. Conclude.
Okay, let's synthesize everything we've learned. We've dissected the business, validated the turnaround, and acknowledged the significant liquidity risk.
We come back to the central finding, the striking valuation gap.
We established the price, $64 million market cap. We established the intrinsic value, $88.5 million in projected high-quality, high-margin revenue.
Supported by a powerful regulatory moat and imminent profitability crossover.
The current price-to-sales multiple is 0.7. The market is pricing this high-growth medical technology firm like a structurally declining brick-and-mortar retailer. It's implying certain failure.
A rational, healthy, growing diagnostic firm with 24% revenue growth and 81% gross margins should conservatively trade at 3 to 5 times sales in a rational market environment.
Let's look at the mathematics of the upside. If we apply a conservative 3 times sales multiple to $88.5 million in revenue, the market cap should be roughly $265 million.
And if we apply a more realistic 5 times multiple, recognizing the high margins and high growth, the market cap would be closer to $442 million.
This means the potential upside, just for the stock to revert to the industry average valuation, is a 3 to 7-fold return.
And the discount today is driven entirely by the fear of the tight balance sheet.
But the sources argue that the operational turnaround achieved in Q4 2025 fundamentally de-risks that balance sheet fear.
So what specific events, what catalysts for re-rating will force the market to recognize this hidden value and close that massive gap?
First and foremost, sustained profitability. Consecutive positive adjusted EBITDA quarters in Q1 and Q2 2026 will dispel the distress discount.
It will eliminate the short seller's primary emotional argument of impending bankruptcy.
Second, scalability proof. Continued reporting of significant growth in the high-margin primary care channel will confirm the addressable market is large and the sales execution is effective.
And third, the hidden asset unlock that validates the development services.
An announcement of a new, major, multi-year companion diagnostic deal with a large biopharma partner would instantly validate the Diagnostic Cortex AI platform as a material, highly valuable asset.
And that would draw the attention of major institutional funds who recognize the long-term royalty potential.
Effectively changing the narrative from a failing lab test company to a scalable AI-driven diagnostic platform.
So for the listener, how do we summarize the asymmetric bet here? What is the risk-reward profile?
The sources suggest the downside is protected. The intrinsic value of the technology, the ADLT status, the established reimbursement pathway, and the proven moat make this an inevitable acquisition target if the stock remains this cheap.
A larger payer or pharma company would buy them just to access the technology in a market position.
But the upside, however, is a massive multi-bagger return if the stock simply reverts to a rational valuation based on the margins and growth rate they have already achieved.
So the overwhelming conclusion from our deep dive into the sources suggests a rare, deep value, high growth profile, exceptionally skewed in favor of the buyer at the current price of $8.07 per share.
The operational evidence for the turnaround is compelling enough to overcome the significant but manageable debt risks.
We focused extensively today on the lung nodule problem, the 98% NPV, the ADLT status, and the current $88.5 million revenue engine.
But the real provocative thought for you to carry forward is rooted in their artificial intelligence platform, the Diagnostic Cortex AI.
That platform is not just a tool. It's an engine trained to find hidden biological patterns across massive proprietary datasets.
And it's currently funded by high-margin development services. So what happens if this AI engine finds the next blockbuster biomarker for an entirely different, massive disease?
Like an early indicator for pancreatic cancer, or a truly sensitive diagnostic for Alzheimer's, or a new target for immunotherapy.
That potential, the sheer scientific leverage of a proven AI platform now generating sustainable cash flow, far exceeds the current $64 million valuation. That truly is the compounder hidden inside what the market perceives as a cigar butt.
If you found the distinction between proteomics and genomics helpful, or if the concept of the ADLT moat blew your mind with its economic implications, be sure to hit that subscribe button. We will continue to bring you these in-depth structure analyses.
This analysis provided is based on AI research, publicly available source material as of January 12, 2026, and is for informational purposes only. It is not financial advice, and you should consult a licensed professional before making any investment decisions.
We'll see you next time on The Deep Dive.